Hi everyone, thanks for coming today to our presentation about what COVID-19 means for commercial property. This week we've been doing a whole collection of presentations to our customers, really just to get on the front foot and let our customers know in a timely manner what's happening in the property space, whether commercial, residential, developer or any other segment of the market, given that there's so much uncertainty at the moment and so much change happening really every hour and every day. We are working remotely, all of us. So if there are any technical issues throughout the presentation, we do apologise. We're not foreseeing any, but we never know. I guess the main point to make here is that the REA Group is doing whatever it can to try and support the industry through this very tough time. And luckily, we're seeing a response from the federal government and the Reserve Bank as well, that they're trying to do their best to support jobs, as difficult as that can be at the moment. There's a lot of news and opinion about what COVID-19 means, what's going to happen, and we're asked for a lot of comments ourselves. There is a lot of news out there from the regular newspapers, but if you are interested in the true view of the market from us, written by us, please visit realestate.com.au/news, and that's the best place to get any information about what's happening. As I said, it's a really fluid situation though at the moment. News and reporting is changing very regularly. We're trying to keep this updated as much as we can, and we're looking forward to being able to present to our customers on a regular basis and update them with what's happening and what our views of the market are. So if we move on now to the actual presentation and the slides, as I said, the impact of COVID-19 is significant, but it's also evolving very quickly in terms of changes to policies, new lockdowns, new stimulus that may or may not be coming. So there's an awful lot going on at the moment. But if we look at immediately what's happening, there's certainly some areas that have been hit rather hard. So the tourism sector is probably the first one that's down, especially given that a lot of the tourism sector was already impacted by the bushfires over late last year and early this year. And we're probably only just starting to come back online. And now we've got COVID-19, and essentially with the borders shut, no one can come into Australia, but also people being encouraged to stay at home. I was reading today that they're starting to patrol the border along Queensland and New South Wales. So people just can't even go interstate for travel. So the tourism sector is being hit very hard by COVID-19. I guess the one potential positive longer term is that you would think that when we get past this current situation, people have been holed up in their house for some time. They're going to be pretty desperate to go for a holiday. You've also got a very low Australian or very weak Australian dollar, so they might be more inclined to go and have a holiday here in Australia. The other sector that's been hit really hard is the education sector, particularly the higher education sector, particularly in terms of Chinese students, because Chinese students have become a real source of revenue for the higher education sector, and they were locked out very quickly. The universities are really struggling because a lot of these students that pay big fees up front aren't able to come back from overseas and start the university semester. Plus, a lot of universities and even schools are now going online, so that's a challenge as well. More recently, we've started to see other sectors, the entertainment industry, any concert or event that's been planned has pretty much been cancelled. Not going ahead at the moment, so that's having a big impact on that segment. Restaurants, bars and cafes. Well, bars are effectively shut down, and pubs, but restaurants and cafes are really only on skeleton crews. They can still be open, but they can't have anyone dining in. They have to be all takeaway. And then you've got some levels of discretionary retail, nail salons, beauty, gyms, those kind of places have been closed down, but somewhat strangely, hairdressers and barbers are still open. And I note this morning that we've actually extended the time you can stay at the hairdresser for up to an hour now, but that's a bit of a weird one to me. But again, thinking about all these people that are impacted, I think a point here to make though is that whilst COVID-19 is happening, these segments, areas of everyday life are really being impacted. But I would expect once the recovery starts, these sectors of the economy are going to be putting on staff very quickly. People are going to be very keen to go out and spend some money, go to their favourite restaurants or pubs and things like that. So I think they'll come back online pretty quickly. But the real truth of the matter is we don't know how long we're going to be in this kind of shutdown phase for, and that's the great unknown. As a result of that, we're seeing that the unemployment rate is likely to increase. Some forecasts have it climbing to as high as 11%, which is the type of unemployment rate we saw during the 1991 recession. And it's very different in this downturn because even in other recessions, businesses can continue to operate. There's a large chunk of retail and services businesses at the moment that simply aren't able to operate. And that's really a different situation to anything we've ever seen in our lives before. For real estate, now this doesn't affect commercial so much, but open homes and auctions are banned. But generally, there's just restrictions on how you can get people through properties and how many groups you can get through at the one time. So that's making the selling process more difficult. Probably not so much of an impact on the commercial market because it generally tends to be private and people can still walk through there if they want. But I would imagine at this stage, given that a lot of businesses have their people working from home, there's probably not a lot of demand for, say, office sites at the moment, or even some industrial sites. But basically, I think what it all comes down to is the fact that businesses and consumers are really nervous. They're nervous about potentially getting sick. They're nervous about being shut down, and they're nervous about the uncertainty as to how long COVID-19 is going to be here. We all know it's a health issue and at some point there'll be a solution, but we don't know when that's going to be. And that just makes people nervous and unwilling to go out and do high commitment purchases. Is there any good news? There actually is some good news. We're starting to see the Chinese economy starting back up again as the fears reside. They had a very hard lockdown. And the economy seems to be coming back online, and that's good for Australia because China, of course, is our biggest trading partner. We ship off a lot of iron ore and coal to China, and we buy back a lot of their electronics and things like this. So they are our biggest export partner, and if their economy can start coming back online, that's really positive for us. Talking of iron ore, projected to be Australia's first commodity to top $100 billion of export earnings in a single year. So that's going to be very positive. I think the other positive is the amount of economic stimulus. We know that the government's already delivered 2 stimulus packages, and there's reportedly on the way. We've seen the Reserve Bank jump into action as well. And again, as I said, this is a health crisis. Once it's passed, there's going to be a massive amount of economic stimulus in place, which is going to be positive for the overall economy, but certainly for the property sector as well. And finally, as I mentioned earlier, the Australian dollar, it's now so weak against the US dollar that it's eventually going to start to provide a great assistance to the exports, assuming it stays at that level for a while. And given that interest rates are going to be at this level for a while, you'd expect the dollar will remain pretty weak. Again, with China, that's good news for us because the Chinese yuan is pegged to the US dollar. So for them, it makes importing a lot of Australian goods and services very attractive, whether that be sending their kids to university here in Australia, whether that be coming to Australia for a holiday, or whether that be, buying food that's been grown and developed here, or buying our natural resources. So if we jump ahead, how can we limit the impact of COVID-19 on property? And really, these should be the priorities. We need to do whatever we can to make sure can remain employed. And any temporary layoffs, there's assistance in place for those households so they can meet their payments, such as rents, mortgages, and even putting food on the table. And again, the government's stepping in with that a little bit. I think my concern about what the government's done, they've needed to react, but no one's received any money yet. The first payments aren't till early April. When someone's laid off, or when they're a casual worker that's had their hours completely cut, they need that money now. They don't need that money in a few weeks' time. So I a little bit concerned about how slow people are receiving those benefits. We need to ensure that firms can get through the next 6 months without going bankrupt, and we are seeing easier borrowing terms, waiving of tax and payroll payments, and direct financial assistance. But again, it's not actually in people's pockets yet, and that's what we need. We also need support for the financial system, assuming that non-performing loans are going to mount. So the crisis, that's a health crisis, doesn't roll into a financial crisis. And again, both and the government are doing some things there. And then we need to provide support for mortgage holders, renters, and lessees, particularly those that lose their jobs. They have their hours reduced because of financial hardship in their businesses. And again, there's been some support for mortgage holders from lenders. There's also been a lot of support for small and medium enterprises from the banks, but also from federal government and the Reserve Bank. But we still haven't seen anything for renters and lessees out of this package. And apparently there's going to be an announcement tonight. But again, renters in particular, in terms of people renting residential properties, are some of the most exposed. They spend more money on their housing costs than someone with a mortgage. And you know, the typical profile of a renter is someone that works casually or part-time, and they're the people that are most likely to have had their hours cut. So I think that support is taking a long time to come through, and that's a challenge. I think just essentially we need to keep the public safe and reduce their risk of infection. And if we can, and look, obviously there's a lot of opinion out there whether we should be in a full hard shutdown or not. But I think if you look at the stats, particularly in terms of infections and deaths, we're doing better than a lot of other parts of the world. But I think there's a sense out there in the community that we could be doing more to keep us safe. And then I think just more generally, we need to proactively list to keep the property market going, and whether that's virtual tours, online auctions, other means of people getting through properties and making decisions about property while still being safe. So again, I just want to reiterate that right now this is a health and productivity crisis that is leading to a pretty sharp downturn, and presumably a short one, although we don't exactly know how long this is going to go for. The finance sector is in good shape, and there's a lot of support there from government and the Reserve Bank. But keeping the economy going is the #1 priority, and that's how we can limit the impact on the overall property sector. So what could a post-COVID-19 world look like? Again, the downturn, we still think it's going to be fairly short and sharp, given that this is health. It's high inflation and high interest rates and a large current account deficit like 91 recession. It's not the payback for deregulation of the banking industry like we saw during the GFC. I think it's increasingly looking likely that the economy is going to go into a recession. But ideally, the government can keep providing that stimulus and support to really cushion how tough the conditions do get in the market. As I said earlier, there is a huge amount of stimulus now, but not only in Australia, but globally. So I think that the rebound in the global economy will actually be quite strong post-COVID. In terms of the first 2 rounds of stimulus, they were relatively light touch specifically for property. They were really more about supporting the economy and keeping people employed, but obviously in commercial property, keeping people employed is a really important part of that. It'll be interesting to see what the 3rd round of stimulus is. Maybe we start to see a little bit more for the property sector, specifically in that 3rd round of stimulus. The interest rates are cut to 0.25%. That will help the property industry because the cost of borrowing is extremely low, and is, as I'll talk about a little bit later, is likely to stay at very low levels for quite some time. We could see some more forms of quantitative easing, moves to ensure firms can keep workers, emergency assistance. It was really encouraging a few weeks, I think it might have only been a week ago now, or 2, I can't remember, but Phil Lowe gave a presentation and really said, once their package of what they were doing, the cut to 0.25% interest rates, that we think at the moment this is going to be enough to support the economy, but if it's not enough, we're willing to do whatever it takes. And that's really the mantra that all central bankers seem to be taking up around the world, that they'll do whatever it takes to support the economy through this tough period. And I think overall, with so much stimulus and such a coordinated effort right around the world, we could see a pretty rapid rebound in growth in the overall economy, fairly similar to what China saw post the SARS crisis. So if we jump ahead, I've got an impact for all sectors, and I know we're talking commercial here, but I might touch on residential because I know everyone's got a home and everyone's actually probably interested in what's happening with the residential market. And then I'll jump forward specifically to the commercial space. But in terms of residential, it's holding up reasonably well. We were pretty surprised how strong auction clearance rates were on the weekend, especially given how high the auction volumes are. But now that auctions and open homes are banned, we'll keep a very close eye on what happens with people removing properties from the market, what happens with auctions transforming into private treaty sales. We also know that people are looking for different ways to list and sell homes other than the traditional measures, and maybe that's online virtual tours, which realestate.com.au announced yesterday for their residential agents, whether it be online auctions or whether it be other measures. In terms of search behaviour, it's certainly higher than it was a year ago, but it is starting to pull back a little bit. Stimulus and interest rate cuts are making it a very cheap time to buy a residential property. And I think also potentially there's a bit of a less concern about property because there is that mantra of things being safe as houses. And we've already seen a massive sell in the equities market. Obviously, that's a very liquid market, highly responsive to changes in sentiment, whereas a non-liquid asset, much more difficult to trade. That's not saying that I don't think prices are going to fall. I think it's realistic that we're probably going to see some price falls over the next little while, but it's not going to sell off like the share market does. And I think, as I said earlier, I think it's a segment of the market that will bounce back pretty quickly. Potentially for people, an opportunity to buy in a downturn and sell in an upturn. Concerns around job losses, though, could impact on renters, as well as leading to distressed sales. There's less of a concern if those impacts are mitigated. Still waiting to see whatever mitigation there is. Also, I think the other point to make here is that the banks are doing a lot to support people that might be in a position where they actually have to go down the distressed sales path. So maybe that will delay things long enough for COVID-19 to have some sort of resolution so that people don't actually have to sell their properties. Probably the one area to watch is investment, because a lot of investors have also maybe taken out margin loans and have got a margin call and may now have to sell their residential property. But I think the main thing we can take from previous downturns is that negative impacts on property is closely linked to what happens with their jobs. And we know that people are shedding jobs at the moment. I think what's different about this recovery or eventual rebound is that I think a lot of those jobs will be put back on fairly quickly once we can start going about everything again. And that's why we think that the recovery is actually going to be pretty strong, because they're going to have cheap access to finance, and there's going to be this level of pent-up demand in terms of property activity. Now, if we jump ahead to the office sector and what our opinions are on the office sector, obviously a whole lot of people around the country are now working from home. So offices aren't being used or are being used on a very skeleton staff kind of scale. There's definitely challenges for tenants and landlords exposed to tourism and education, also other sectors like retail. I saw today that Flight Centre's standing down 3,500 staff. A number of other businesses are standing down staff as well. We know Qantas has already stood down 18,000 staff, But I think also for people that are working in offices, cleaning and hygiene is a real priority for them at the moment. If we look at potential outcomes post-COVID-19, depending on what happens with businesses and if they are able to hold on, we may see some increases in vacancy rates and a decline in rents because people are simply out of business. I think depending on how successful or otherwise this working from home kind of experiment is over the next however long, there may be some considerations around changing how we use offices. I mean, a lot of companies already don't have enough seats for how many staff they have and encourage people to work from home. But potentially that they'll be encouraging more people to work from home. Potentially also, given that we've seen breakouts in certain areas and not other areas, maybe businesses will start to consider having more people located in remote offices. We know that most businesses are based in Sydney or Melbourne. Maybe they'll start to see some benefit in building up, or taking some of the teams out of those cities and maybe moving them to other parts of the country. So when one office gets very sick or something happens somewhere, it doesn't necessarily have as big of an impact on the whole business unit. We may see some distressed sales and possibly some increases in yields, but it's unlikely that it's going to be as bad as the post-GFC period, largely because I think, as I said, the market is likely to bounce back fairly strongly once we get through this. And I think there's going to be a negative impact on share offices as well as hot desking. So if we then go to the industrial sector, immediately, greater demand as people look for more deliveries and self-isolation. I mean, I think about this and I think someone like Amazon's probably going to do very well out of this. Obviously, Netflix, everyone's going to be home with not much to do. They're going to be streaming. Places like Kogan will do quite well as well. Again, cleaning and hygiene is really a priority, and anyone really exposed to the tourism sector in the industrial sector is likely to be impacted. Post-COVID-19, I think it's reasonable to expect some increase in vacancy. At this stage, though, I think the increase in vacancy is likely to be less so than we'll see in other office sectors or commercial sectors, rather. It is still the asset class of choice from investors, and I think that we'll probably see some greater investment in medical and pharmaceutical research, and that will benefit industrial sector as well. If we then look at the retail sector, this is probably the one that's going to have the biggest impact. We know supermarkets have been doing very well because people have been panic buying. And anything that's non-discretionary, really. So pharmacists doing very well. Bottle shop, and not that you absolutely have to drink alcohol, but we know that bottle shops are doing quite well as well. But cafes, restaurants, bars, tourism, entertainments, gym, these areas are really struggling, and again, hopefully they can hold on, but they're really going to struggle over the next few months. With more people at home, it could be some good news for some retailers. People having to rush out and buy screens and computer stands and this kind of thing. Good for someone like JB Hi-Fi or maybe Harvey Norman if Jerry Harvey could stop talking. Amazon likely to do well as well, but bad for other things like fashion. I think people are increasingly starting to take COVID-19 more seriously and will be less inclined to go out and do big shopping at shopping centres around a lot of other people. And health and safety issues are obviously there for staff, ranging from exposure to COVID-19, but also violence in supermarkets. We've seen some evidence of people losing their minds at the supermarket, abusing staff, fighting with other people. So there is that challenge as well. Post-COVID-19, retail was doing it fairly tough. And I'm not going to say that I expect it's going to just miraculously turn around, but I think we will see post-COVID-19 a bit of a bump in retail spending, just because people haven't been able to do it or won't be able to do that for a period of time. They'll be really keen to do it once they're kind of allowed to again. In terms of medical-related property, obviously hygiene issues are critical. Strong demand for services, and it's expected to get stronger. I think post-COVID-19, we might actually see the government spending more on health, given what we've seen, and then probably likely to be some new development in this area as well. So that's it in terms of the impact on the commercial sector. But what I wanted to talk briefly about is what the federal government's done. And I'm not going to go through this whole package in great detail, but I think what I kind of wanted to highlight is just that the federal government is responding. Their first stimulus package was $17.6 billion, and pretty quickly it was discovered that was nowhere near large enough. That first package was really, as I said earlier, about trying to keep people employed and helping employers through the period, and helping anyone that lost their job. And then the second stimulus package at 66.1 billion was much larger. Again, really targeting people that lose their jobs and trying to encourage businesses through this tough period, and making sure that banks can continue to lend through this period as well. We don't have a shutdown of the banking system. That would be the worst thing possible. So there is another stimulus package supposedly in the works. I'm not sure when we're going to hear about that, but it'll be interesting to see what comes out in that. Along with what the federal government's done, the Reserve Bank has jumped in and helped as well. They've cut the cash rate to 0.25%, which is, in their words, essentially as low as it could go. I mean, you could technically have negative interest rates, but they're saying that 0.25% is as low as interest rates can possibly go. The cash rate's now in line with the US Fed, Bank of England, Reserve Bank in New Zealand. And really, everyone's using that scope to those low interest rates to support the economy through this challenging period. The interesting thing with the Reserve Bank when they announced this cut, though, was that they mentioned that they're not going to increase the cash rate until such time as we're making meaningful movement towards full-time employment, which is, full employment, which is 4.5% or lower, and a period where they can get inflation sustainably within the 2 to 3% target range. Now, even before COVID-19, they weren't really making much progress on heading towards full employment. It was hanging around that 5 to 5.5% range for quite some time. Obviously, it's likely to jump. And even with inflation, underlying inflation from the Reserve Bank hadn't been within the 2 to 3% target range for 4 years. So even before this, they weren't able to hit their inflation targets. Now, the Reserve Bank's kind of flagging that they expect that this will take 3 years. So interest rates will be on hold for around 3 years, but I suspect it could actually be a lot longer than that, depending on how quickly the recovery in the economy is, but also how successful they are at lifting inflation, given that they haven't been particularly successful of late. And because of this, they've done a target yield of 3 year, a target yield for 3-year government bonds at 0.25%. Basically to match the cash rate and make sure that the Australian government can borrow at very cheap rates over the next few years. They've also announced a term funding facility for banks to support credit, particularly to small and medium businesses. So what they're actually doing here is they're offering banks the ability to borrow basically at the cash rate at 0.25%. Banks will have access to at least $90 billion worth of funding. And there's some incentives in here. So for every dollar that an ADI will lend to a large business, they have access to an additional $1 of funding at that 0.25%. But if they lend to a small and medium-sized business, for every $1 they lend, they're going to have access to an additional $5. So you can see what they're really trying to do here is to incentivize the banks and the lenders to continue to lend, but continue to lend particularly to small and medium-sized businesses. We've also seen an adjustment to the interest rate on exchange settlements balances. This is a bit kind of wonky, but essentially when you're a trading bank, you need to have a certain amount of cash at the end of the day on hand, on call. And when banks have excess cash or a surplus of cash, what they'll do is deposit that overnight with the Reserve Bank. And when they don't have enough cash, they'll borrow overnight from the Reserve Bank. So what's historically happened in the past is if you deposit cash with the Reserve Bank overnight, you'll get an interest rate 25 basis points below the cash rate. And if you borrow, you get charged interest 25 points above the cash rate. But with the cash rate at 0.25%, if you were to deposit under these rules with the bank overnight, you get no interest. So now you get 0.1% interest. If you're borrowing, you're still paying 25 basis points above the cash rate. So it's basically, giving lenders some return if they have excess cash that they have to deposit overnight. So these steps are all, again, really targeted on keeping borrowing costs low and encouraging lenders to lend to small and medium business in particular, but also large businesses. And the big four banks have had their own responses. So there's been significant decreases to fixed rate mortgages, mortgage deferral options for people affected by COVID-19 between 3 and 6 months. And depending on how long this carries on for, you would expect that it could stretch out longer than that. And big increases to term deposit rates. And then for the small and medium businesses, there's been reductions in interest rates for new lending, reductions in interest rate overdrafts, and a lot of financial hardship options and options for deferral of repayments if required. So everyone's kind of pulling their finger out and trying to help support the economy through this tough period. But I think the reality is that we're still going to see the unemployment rate rise, and we're probably going to see the economic performance of Australia drift lower and a recession with 2 consecutive quarters of negative growth. So I've just pulled on some older data, what was happening before we hit COVID-19, and it's probably not so relevant now, but anyway, it's interesting to have a look at. So on Real Commercial, distressed listings were generally pretty low, but there was a spike in development site distressed listings late in 2019. This is probably all set to change over the next couple of quarters. In terms of the office leasing market, which is our next slide, office vacancy rates were pretty strong, particularly in New South Wales and Victoria. Again, I think we could see the office vacancy rate drift a little bit higher on the back of COVID-19 over the next part of this year. And one of the challenges for the office market is also going to be that there's a lot of new supply coming online, particularly in Melbourne and Sydney, and to a lesser degree Brisbane, and it's not all pre-committed. So there's going to be some challenges in that office space as well, especially if there's less demand for office space going forward. So from here, I kind of just wanted to jump more into the economic picture and what's happening and what we can learn from previous slowdowns like the GFC, like the recession back in 1991. Again, keeping in mind that the drivers of those slowdowns were very different to the driver of the slowdown we're seeing at the moment. But we all know Australia hasn't had a recession for 29 years. No Reserve Bank governor, no Prime Minister, no Federal Treasurer wants to be the one that has the next recession. But I think it's looking increasingly likely that we are going to get a recession throughout 2020. Again, not caused by the financial system, not caused by high rates of inflation, but caused by a global health pandemic, which essentially is meaning that people can't continue to go about their normal lives, and businesses that would even usually be able to operate during an economic downturn simply can't operate anymore. And I think really this next slide sums it up nicely. It's the consumer confidence side. So each week, ANZ and Roy Morgan publish confidence index, and you can see that last week it just dropped, like a sinker in a bathtub. It just dropped dramatically. It fell 27% in 1 week. They haven't published a long time series of this data in this chart, unfortunately. But what the commentary from ANZ said is that confidence is now lower than it was any time during the GFC. And the last time it was this low was at the depths of the 1991 recession. And it was only slightly lower than it is currently. And this is really the crux of the problem at the moment. Because no one knows really what's happening, how it's spreading, what drugs are effective against COVID-19, when we're going to have some sort of vaccine or solution, people are just scared, and their confidence in the economy about anything has really been shot. And we know, particularly in the property sector, it's generally a market that you need to be pretty confident that your business is going well and you want to expand, or you've got to be very confident that you're going to keep your job and you want to go out and buy a brand new home. So this is really the thing I think that's going to impact on the property market the most, just that lack of confidence. In saying that, I do think once confidence starts to recover, the overall recovery is going to be quite strong as well. If we go to the next slide, which is underlying inflation, as I mentioned earlier, you can see the grey bars there, which is the Reserve Bank's target range for inflation, which is 2 to 3%. Now that target range came in 1993, I think, and the target was over the period to get inflation to sit within that target range. And you can see that most recently they haven't been particularly successful at doing that. And that's why I'm maybe a little bit skeptical that the Reserve Bank's kind of flagged that the cash rate will be on hold for 3 years and won't move until such time as they start making progress towards their target range for inflation and towards their full employment goal. I'm a little bit skeptical that they're going to be able to achieve that within 3 years, given their track record over the last few years of how they're going with inflation. We then look at the cash rate. Obviously, borrowing costs have come down. This is mortgage rates, but commercial borrowing costs are following a similar trend. We've had the further 0.25% cut to interest rates. Borrowing costs are the lowest they've ever been. And again, I think this is one of the things that gives us some hope once we get past the current health crisis that we have, that the rebound is going to be quite strong because there is a lot of stimulus. Interest rates are very low and are going to remain at a very low level for some time, 3 years, according to the Reserve Bank, maybe a little bit longer, according to me. And that's going to encourage people, once that confidence does start to recover, to go out and borrow and spend. And hopefully it will also encourage businesses to go and reinvest and start expanding again. If we then have a look at unemployment rates, this will be the really interesting chart to watch. So if we have a look at what happened in the 1991 recession, now it doesn't show it here, but before the 91 recession, unemployment rate reached a low point of about 5% and it jumped up to 11.1%. 11% is the forecast for the unemployment rate from Westpac and from JP Morgan and a couple of others as well. So, pardon me, what they are saying is they expect a pretty severe jump in the unemployment rate, given that we're currently at 5.1%. Even in the GFC, you can see where we didn't fall into a recession, the unemployment rate over a very short period of time jumped from 4% to 5.9%. And we've never been able to get anywhere near close to back to that 4% unemployment rate that we had before the GFC. The other line that we have on there is the participation rate. What you can see there is that at the moment, employment participation, which is anyone that is employed or actively looking to be employed, is the highest it's ever been. But again, we also see in the recession that people often lose hope of getting employment and leave or quit completely trying to look for a job. So it might not sound like a massive fall, but you can see that the participation rate fell from 64.1 to 62.1% during the 1991 recession. And even during the GFC, it slid down from 65.7% to 65%. So if we then go to the next slide, which is looking at business credit from lenders, and you can see that since the GFC, credit growth, or I guess the growth in credit is really driven by demand and the willingness for banks and lenders to actually lend to people. But you can see that credit growth has been fairly benign since the GFC, and although banks are all saying they're open for business and they're willing to lend, it's going to be very interesting to see how these figures change. If we actually do see businesses starting to borrow and credit growth pick up, or if it continues to remain in the doldrums. But I think either way, it's unlikely, particularly while COVID-19 is here, that credit growth will get up back towards those pre-GFC levels. But again, I think the aftermath of COVID-19, we could see a pretty strong bounce in demand for business credit. Retail trade, which is our next slide, I think this is really the one for me that we need to keep a close eye on, because even in the 1991 recession, we can see that retail trade actually continued to tick over. I think it's going to be very different. I mean, in recessions, yes, people have less money, people lose their jobs, confidence is shot, but they can still go and spend money. I mean, those people that have jobs can still go and spend money. They can still go out to a restaurant and they can still go out to a cafe. It's very different in this situation that people simply can't do that anymore. They can go and grab a coffee and a takeaway, but they can't sit down at a fine dining restaurant and have a nice meal. They can't go out for a Saturday morning breakfast like they used to. So it's really changing people's everyday lives. And I wouldn't be surprised if we actually see a big contraction in retail trade over the next little while. And then if we go to the next chart, population growth. The data is very lagged. We only got September data earlier this month. And really at a national level, there's two drivers. There's natural increase, births minus deaths, and then there's net overseas migration. How many people leave Australia compared to how many people come to Australia? And you can see for a long time, we've had a very strong rate of net overseas migration. That's actually really helped our economy and probably kept us from a recession in the past, to be perfectly honest with you. But I think the point here is, with the borders closed, we'll probably still see some net overseas migration up to March of 2020, but the June quarter, there's, depending on how long this lasts, that's going to fall to absolutely zero. And again, people coming in and creating more demand is one of the things that keeps retail ticking over, keeps businesses ticking over. So that's going to be a challenge. Again, I think one point to make here, though, is Australia, although there's been a lot of criticism about not shutting down the whole of the country and these types of things, Australia, relatively speaking, is doing better than a lot of countries in terms of this COVID-19 health crisis. People are getting infected, but the rates of death are quite small. You compare it to somewhere like Europe, for example, and the breakout and the high rate of death we've seen in areas like Spain and Italy. Maybe coming out of this, Australia actually becomes an even more attractive destination for people from offshore. When you consider that we're a continent that's our own country, we don't have that free movement of borders like they have in the EU, and we have a free health system, and we have a health system which at this stage, and I hope, knock on wood, I hope I'm not talking out of turn, but is holding up reasonably well in the face of COVID-19. And if we can continue to do that, then it may make Australia an even more attractive place for people from overseas to come and move to. So who knows, but we'll wait and see. But overall, I think one of the challenges is the high level of household debt here in Australia. We also know that a lot of small businesses are funded by the equity in people's properties. And we do have a very high level of housing debt overall. Now, the value of those assets are significantly higher than the value of the debt. But if we look at what's happened at the share market, part of the household assets includes superannuation balances, any equities that they're invested in, and obviously also property. So we're already seeing superannuation balances falling. We're seeing share balances falling. And there's a very real possibility we'll start seeing residential property prices start to fall over the next little while as well. So that means that the value of the assets is going to decline, but the challenge is that the value of the debt against those assets doesn't decline at the same rate. And I think that's one of the things that really makes that confidence story a challenge as well. If people start seeing the price of their home fall, then that gives confidence even a bigger hit. Again, hopefully this is only a short-term challenge for the economy, but if it drags on longer term, I think that will be something to watch very carefully. And I think that's why the banks in particular are offering a lot of hardship options, not just for small and medium businesses, but also for residential property, people that own residential property. So what does this all mean? In summary, housing, and I actually should have said property, but property overall is an asset class that really thrives on confidence. And really at the moment, consumers are worried. But there's definitely some positives out there. Mortgage rates are the lowest they've ever been. Business borrowing rates are the lowest they've ever been, and they're likely to remain at that level for some time. Property transactions can still occur. People just need to be smart about how they show properties. Probably not so much of an issue in the commercial space, but certainly in the residential space, agents need to change their ways. I think it's also potentially a good chance for the industry as a whole to really start innovating. The property sector I would categorise as one that's typically quite slow to move with new innovation. But given this changed environment, it's a good time to start thinking about some innovations we can put in to really help our customers. As I've said a number of times throughout the presentation, the volume of stimulus in place means that we expect that the economic rebound post-COVID-19 is likely to be strong. As I said, people are going to be cooped up for a period of time. They're not going to be able to spend. And I think once they're able to get out and spend again, they're going to be desperate to do that. I mean, I know that barbers are still operating, but I'm not going to be going out and getting a haircut. So I'm going to need a haircut when I get out, probably need some new clothes. We'll probably want to go and eat at some nice restaurants, go out to some cafes for some breakfast. And that's all going to help the economy when that starts to happen again. The banks have repeatedly said that they're open for business and ready to lend. So you can access finance if you need it. But again, the challenge is having the confidence to go and get finance now for projects that you're going to deliver in the future. In terms of just generally with regards to property, I think people and businesses are going to have a lot more time on their hands over the coming weeks and months to research and consider their next property move. So what I said to the developer clients yesterday is they need to keep promoting their projects. And I think for commercial property owners, it's exactly the same. They need to continue to advertise, put information out there about the market, let people make a decision. You know, they're going to have a lot of time to think and make decisions over the next little period. Let's give them what they want. Let's help them make that decision for themselves. And then, as I've said as well earlier, the dramatic fall in the Australian dollar is going to be very stimulatory for longer term. In the short term, however, there's global uncertainty. People are likely to lose their jobs. Some major projects and investment may be delayed. I mean, we're lucky at the moment that development sites are still able to go on and work, but if that shuts down, then that's going to slow the economy even further. The economy is already slowing, as I've said. The expectation is that there will be a recession, but I think it's good that the government and the Reserve Bank are monitoring these things and prepared to provide support and stimulus for individuals and business. And certainly the Reserve Bank governor, when he spoke, was saying all the right things about being prepared to do whatever it takes to support the economy over this period. So that's the end of my presentation, but we've had some questions sent through, so I'm going to do my best to answer those questions for you. So I'll read them out. Can you explain why you think co-share offices like WeWork would be adversely impacted post-COVID? I read an article that suggested tenants may be drawn to these post-COVID so that they're not caught in long-term leases. Yeah, look, I think honestly it could really go either way. But I think the comment about WeWork is more that you're working with other people that don't work in your business. You know, you don't know what their hygiene's like. You don't know what their rules are about how they feel about coming into the office when they're sick or not. You don't know who they are, so you don't know what sort of cleanliness they have, where they've been. Whereas if you're working in an office with people, you know, you've got a much better idea about that. So, look, I agree, could possibly go both ways. But my personal view is that you know, people might be adverse to sharing with people that they don't know, and maybe more inclined to go for their own office space. Were there any other questions? I know Siobhan's grabbing anything you have and desperately sending them to me if you've got any. So if you do have any questions, please put them in the channel there, and I'll get them sent through to me, and I'll try to answer them. Seeing one come through now, which is good. Sorry about the delay. I can't see the questions on my end presenting, so it'll just be a minute. But again, I hope you all enjoyed the presentation. Hopefully it gave you a bit of an idea of what our thinking is. And I think the main takeaways are it's going to be a challenging period, and there's a lot of uncertainty out there. And But I think the important thing to take away is there's a huge amount of stimulus. There's a lot of support out there in the broader economy, and we do expect that the rebound's going to be quite strong. Will we get a copy of the slides in the presentation? The answer, I'm told, is yes. So I think what they're actually doing is a webcast of the presentation with audio, and I think that will be available, but we are going to be able to give you access to this after the event. The next question I have is, do you have any idea when we might hear from the government regards to how they intend dealing with rents? I don't know particularly about commercial rents. The talk is that there's going to be an announcement about rents tonight, but I have the sense that that is residential rents, not commercial rents. So I don't know. Maybe there will be something for commercial in tonight's announcement, but I have a sneaking suspicion it's going to be more about residential rents. How do I think COVID will affect overseas investment in the commercial space? That's a good question. Obviously, I think not a lot's going to be going on at the moment, but I do think, again, some of those positives about Australia, you know, connectivity to Asia, the low Australian dollar, particularly the low Australian dollar, I think could encourage a lot more overseas investment in the commercial space once we start to bounce back from COVID-19. What do I foresee being the emerging commercial assets to watch in the post-COVID-19 market, and why? Look, I think industrial is still going to be a pretty strong market afterwards. Logistics, I mean, we're all going to be sitting at home buying things online instead of going out to shops, and we'll probably discover that it's a good way to go. I mean, we've been a lot slower to take that up here in Australia than they have been in, say, the US or parts of Europe. So I think that segment, I'm not saying that retail is going to shoot the lights out, but I do think that post-COVID-19 there will be a rebound in retail, because people will also want to get out of their house, will want to go and spend some money, will want to go back to the shopping malls, will want to go back to their favorite restaurants and cafes. So I think there's an opportunity there. Is the driver for, oh, that one disappeared. Sorry. I'm happy to answer it. It was the driver, do I think the driver for migration will continue to be Asia, or do I think there might be some more European? Look, I think the main driver will continue to be New Zealand, China, the UK, obviously going through Brexit. It'll be harder for people in the UK to come and buy properties in Spain and places like that. So maybe we'll start to see, pardon me, we'll start to see some more UK migration to Australia, but I think largely it'll be China, but I wouldn't be surprised to see an uptick in migration from Europe. What are my views on development in light of COVID-19? Will different types of property development respond differently to construction timing, office versus, for example, office versus industrial? I think so. I think the industrial sector will probably bounce back quicker. And as I said, I think that's probably the market that's still going to be quite strong. The office sector, I think it might actually go a little bit like the residential development segment at the moment. They'll probably wait to see what happens with those overhangs of properties that are under construction, what the leasing profile of that looks like as it comes up to completion, before really delving in and starting to produce new projects. All right, if we don't have any more questions, no, there's another one coming through. No, it stopped coming through. No. Australian dollar is very cheap now. Will overseas investors come and grab property? I don't think they will right now, but assuming it stays very cheap, once we start to rebound from COVID-19 and with low interest rates, I don't see a good reason why it won't stay low. Then I would expect overseas investors will come and grab Australian property, because it does look very cheap. I mean, the Australian dollar against the US hasn't been this low in about 13 years. That's pretty appetizing for overseas investors at the moment. Cameron, touching on your point about office markets, do you think the predominant CBD tenants may look at outer suburb office markets to split their workforces to avoid something like COVID-19 again? Potentially, I would think maybe that their initial thing, Sydney and Melbourne tenants might actually start to look at putting more staff in places like Brisbane or Adelaide or Perth even. But there's a potential outer suburban office market. Maybe moving call centres out of CBD areas to some of these areas. Non-customer facing roles might move out to the suburban markets as well. I don't know how that will necessarily go with staff, but I think it could be something that they consider. Do you not think the government will need to address tenancies where they have forcibly closed the business? I think they're going to have to do something. Certainly, I think there's providing support for all other segments of the business community. I think they need to do something about that. Does the build-to-rent sector lack stimulus for 3 years while we reset, or is demand strong enough to encourage developers? The rental market's actually really interesting at the moment, because if you think about what's happened over the last few years, so many people have pulled their properties out of long-term rentals and put them onto Airbnb. But Airbnb's basically become unviable at the moment. So it's still very early days, but what I expect or suspect that is actually happening is a lot of people that have Airbnb rental properties, particularly in places like Sydney or Melbourne, are now starting to put those properties back into the longer-term rental pool. Pardon me. And that is going to actually depress rents a little bit. I've already heard from some people at REA that were asking about some rental accommodation a while ago, that the agent's getting back in touch and saying, hey, this is now $40 cheaper than when you were looking at it. And I expect that we're going to see more of that. So I'm not sure. I actually think we might see a little bit of a pause in that build-to-rent segment for the next few years. I guess it will also depend on how rapidly the market rebounds back after COVID-19. I mean, remember, essentially, we can't go on a holiday anywhere at the moment. So people will be pretty desperate to go on a holiday, I think, as well, or at least go for a long weekend somewhere. And that could mean the rebound in Airbnb is quite strong. Cameron, do you think the government will make it easier for people to access their super during these times? Well, they already have. They've said that you can withdraw up to $20,000 rather from your super. Whether that's a good idea or not, I don't think it's actually a very good idea. Look, I actually think that the super system as a whole needs to be reworked, and maybe super is not the best way to save for your retirement. But I also think letting people have access to their super when the share market's just dropped 40% is probably not the greatest idea at this stage. All right, I think we might end it there. Thank you all very much for your time. I really do appreciate you attending today. Hopefully you got a lot out of it. Hopefully I could answer some of your questions. And thanks again. And I think the plan is to do this on a semi-regular basis, keep our customers up to date. So we'll certainly let you know when we're doing the next session. I am seeing that there's one coming through. Do I see landlords finally reducing retail rents to secure long-term tenants? I think they may not have a choice, given what we've seen, and given that the fact that there are going to be some businesses that go out of business over the next few months. So I think they might have to. Please don't forget that your account manager at realcommercial.com.au is here to support. So if you need any help, get in touch with them. As I said, we'll be running more webinars and providing you as much information as you can to get through this time. And while there's a lot of uncertainty, the team at realcommercial.com.au are here to support you. So thank you very much for today.